Thank you for listening to the Tortoise and the Hare Financial Podcast. My name is Jim Leo. In this podcast, I'm actually going to go through two articles that I found quite interesting. The first one is a deVere survey which reveals millionaire investors' biggest mistakes. And then the second article that I'm going to go through is called The Facts About Investor Behavior. Now, I'm going to include the link to both the articles in the podcast description. But before we get started, let's hear a word from my sponsor. We're going to start off with the facts about investor behavior. And again, the link to this article is in the podcast description. So if you want to read it for yourself, be my guest. So let's get started. Where do you, as an investor, fit in? That's a good question, right? Insight into the theory and findings of behavioral finance may help you answer this question. Now let's question rationality theory. Economic theory is based on the belief that individuals behave in a rational manner and that all existing information is embedded in the investment process. This assumption is the crux of the efficient market hypotheses. But researchers questioning this assumption have uncovered evidence that rational behavior is not always as prevalent as we might believe. Behavioral finance attempts to understand and explain how human emotions influence investors in their decision-making process. You'll be surprised at what they have found. Now, they're referencing a Dalbar study that was released in 2001, and I actually had the opportunity to review that study at the time I was finishing up my career at Scotiabank, and they had an agreement with Dalbar, and they did provide us with the report itself. It was quite interesting. So in 2001, Dalbar, a financial services research firm, released a study entitled Quantitative Analysis of Investor Behavior, which concluded that average investors fail to achieve market index returns. It found that in the 17-year period to December 2000, the S&P 500 returned an average of 16.29% per year, while the typical equity investor achieved only 5.32% for the same period. That's a startling 9% difference. It also found that during the same period, the average fixed income investor earned only a 6.08% return per year, while the long-term government bond index reaped 11.83%. In its 2015 version of the same publication, Dalbar again concluded that average investors fail to achieve market indexed returns. It found that the average equity mutual fund investor underperformed the S&P 500 by a wide margin of 8.19%. The broader market return was more than double the average equity mutual fund investor's return, 13.69% versus 5.50%. Averaged fixed income mutual fund investors also underperformed at 4.81%, under the bond market. So why does this happen? Well, here are some possible explanations. And the first one is investor regret theory. Now, fear of regret, or simply regret theory, deals with the emotional reaction people experience after realizing they've made an error in judgment. Faced with the prospect of selling a stock, investors become emotionally affected by the price at which they purchased the stock. Now, I'm going to use an example. I've worked with clients who come to me and they talk about their winners, right? Usually they get excited about it. It tends to be some kind of penny stock that they started off at, for example, 20 cents per share. And they're excited because the value of that stock price had reached $2, $2.50, $3 per share. And I usually ask them, so when are you going to sell? And people generally don't sell. They get caught up in the excitement. They get caught up in the emotion of that growth of that stock, thinking that it'll just keep going up and never come down. So they hold on. And that's where the biggest mistakes are made. And then what tends to happen is some news comes out And all of a sudden, the value of that stock starts to decline, maybe slightly. And the investor will sit there and think, well, I'm still ahead. I'm just going to ride this out because I'm sure it'll turn around and continue on growing. And then what tends to happen, and I've seen this many, many times in my career, the value of that stock continues to drop. It might even get back to that 20 cent on the dollar or 20 cent per share price. So now they've broken even. And again, in that situation, the investors still choose not to sell. And then what happens is, you know, the value might end up dropping below that initial purchase price of 20 cents. It might even be down at 10 cents per share. And at that point, the investor typically says, I'm just going to hold on. I know I'm at a loss. I'm not going to make my money back, or I'll just hold on and hope that some day down the road, things will turn around for the stock. Now, think about it. If they purchase it at 20 cents a share and it reached, call it the 250 mark, and they're now sitting at 10 cents a share, they have lost 50% of their investment in that stock alone. And this happens on a frequent basis. I always suggest to my clients, if they are going to go and do their own investment, open up a small little trading account, and they're going to dabble in the stock market, usually I suggest they look at no more than 5 to 10% of their total holdings. And I always suggest that they put a strategy in place where they've set a target price. So once that stock reaches that target price, no matter what, they sell. They take the profit and they sell. But it never happens. So I'm going to continue on here. So they avoid selling it as a way to avoid the regret of having made a bad investment, as per what I just shared with you, as well as the embarrassment of reporting a loss. We all hate to be wrong, don't we? What investors should really ask themselves when contemplating selling a stock is, what are the consequences of repeating the same purchase if this security were already liquidated and would I invest in it again? If the answer is no, it's time to sell. Otherwise, the result is regret of buying a losing stock and the regret of not selling when it became clear that a poor investment decision was made. And a vicious cycle ensues where avoiding regret leads to more regret. Now, the regret theory can also hold true for investors when they discover that a stock they had only considered buying has increased in value. Some investors avoid the possibility of feeling this regret by following the conventional wisdom and buying only stocks that everyone else is buying, rationalizing their decision with everyone else is doing it. Oddly enough, many people feel much less embarrassed about losing money on a popular stock that half the world owns than about losing money on an unknown or unpopular stock. I've seen that with people wanting to invest in marijuana stocks. I've actually seen it in people wanting to invest in precious metals like gold. I've seen it with in the Nortel days. This happens repeatedly over and over and over again. Now, let's talk about mental accounting behaviors. Humans have a tendency to place particular events into mental compartments, and the difference between these compartments sometimes impacts our behavior more than the events themselves. So let's use an example here. Say, for example, you aim to catch a show at the local theater, and tickets are $20 each. When you get there, you realize you've lost a $20 bill. Do you buy a $20 ticket for the show anyway? Behavior science has found that roughly 88% of people in this situation would do so. Now, let's say you paid for the $20 ticket in advance. When you arrive at the door, you realize your ticket is at home. Would you pay $20 to purchase another? Now, only 40% of respondents would buy another. Notice, however, that in both scenarios, you're out $40. Different scenarios, the same amount of money, different mental compartments. An investing example of mental accounting is best illustrated by the hesitation to sell an investment that once had monstrous gains and now has a modest gain. During an economic boom and bull market, people get accustomed to healthy, albeit paper gains. When the market correction deflates investors' net worth, they're more hesitant to sell at the smaller profit margin. They create mental compartments for the gains they once had. causing them to wait for the return of that profitable period. So let's just pause here for a second and think about it yourself. If you've been someone who has invested on your own in the past, can you think of examples like this that have come up? They happen more often than you think. Now let's talk about prospect and loss aversion. It doesn't take a neurosurgeon to know that people prefer a sure investment return to an uncertain one. We want to get paid for taking on any extra risk, and that's pretty reasonable. Here's the strange part. Prospect theory suggests people express a different degree of emotion towards gains than towards losses. Individuals are more stressed by prospective losses than they are happy from equal gains. And I will admit, I feel that as well, even with my own personal portfolios, when working with clients. I do feel the difference between the two. Now, an investment advisor won't necessarily get flooded with calls from his client when he's reported, say, a $500,000 gain in the client's portfolio. But you can bet that phone will ring when it posts a $500,000 loss. A loss always appears larger than a gain of equal size. When it goes deep into our pockets, the value of money changes. Prospect theory also explains why investors hold onto losing stocks. People often take more risks to avoid losses than to realize gains. For this reason, investors willingly remain in a risky stock position, hoping the price will bounce back. Gamblers on a losing streak will behave in a similar fashion, doubling up bets in a bid to recoup what's already been lost. So despite our rational desire to get a return for the risks we take, we tend to value something we own higher than the price we'd normally be prepared to pay for it. The loss aversion theory points to another reason why investors might choose to hold their losers and sell their winners. They may believe that today's losers may soon outperform today's winners. Investors often make the same mistake of chasing market action by investing in stocks or funds which garner the most attention. Research shows that money flows into high performance mutual funds more rapidly than money flows out from funds that are underperforming. And again, this is something that I experience and have experienced over the last 30 years. And it keeps coming up. We've dealt with a bit of a market run this year, and some of the big six tech firms have performed really, really well. For example, Shopify, Microsoft, Amazon, Apple. And whenever I've sat down with a client and we do a review with one of our portfolio managers, they insist and always ask the question, well, why aren't you buying up all these stocks everybody else is? And the response from our portfolio managers, regardless on which firm we're working with, has always been the same. They're not in our risk profile. See, the thing is, when everybody's going after those stocks, it does push the value of those stocks at times. But one bit of bad news or news that might impact the value of the stocks, you can see a sharp decline, and it's very difficult to get out in that situation. So we need to really kind of sit back and maybe do a little bit less of following the herd of sheep, or I've said that many times to people. Let's stop following everybody else. Let's sit back for a minute to see if it actually makes sense. And if it does, let's continue on with that sheep herd. But maybe they're actually walking over a cliff and they don't know it. We don't want to be part of that herd if that's the case. Now let's talk about investor anchoring behaviors. And this happens again on a frequent basis. In the absence of better or new information, investors often assume that the market price is the correct price. People tend to place too much credence in recent market views, opinions, and events, and mistakenly extrapolate recent trends that differ from historical, long-term averages and probabilities. In bull markets, investment decisions are often influenced by price anchors, which are prices deemed significant because of their closeness to recent prices. This makes the more distant returns of the past irrelevant in investors' decisions. There is a recency bias. People tend to read a lot of the information and make a decision based on what's being reported. And again, if you're someone who wants to invest some of your portfolio or even all of your portfolio for that matter, you really need to do proper research and not follow the trend that everybody else is following. Now, here's one that I see all the time, and a lot of it's driven by events, a lot of it's driven by media reporting, and this is the over and under reacting. And I'll give you a perfect example. I spent about a month to 2 months leading up to the US election where I was asked my position on what might happen in the markets if either Biden was voted in or if Trump was voted in. And my honest answer was, I don't know. I don't have a crystal ball. I can't predict it. No one really knows. And you might have 25 different predictions, and one of them is bound to be right, but they're guesses at best. So there is a lot of over and under reacting, and sometimes people will, there is a knee jerk reaction, right? And will make decisions by overreacting. Not a good thing. So let's talk about this. Investors get optimistic when the market goes up, assuming it will continue to do so. Conversely, investors become extremely pessimistic during downturns, a consequence of anchoring or placing too much importance on recent events while ignoring historical data is an over or under reaction to markets, which results in prices falling too much on a bad news and rising too much on good news. At the peak of optimism, investors' greed moves stocks beyond their intrinsic values. When did it become a rational decision to invest in stock with zero earnings and thus an infinite price to earnings ratio? Think the dot-com era circa the year 2000. Extreme cases of over or under reaction to market events may lead to market panics and crashes. And this is what I see. I see a lot of people, for example, who are invested in portfolios, mutual funds, whatever it might be, and they believe that they should be liquidating and going back into the market using these portfolios. You have to understand that that's what the portfolio manager's job is to position those portfolios. So if they do believe there's a bit of a correction, or if the market is overpriced, to maybe pull back on their position in the equity markets and hold more cash than most people probably would hold during a hot market. And, on the flip side, once there is that correction that's taking place, that portfolio manager now has the cash to go ahead and start buying some equities that are on sale. And that's when everybody else is pulling out of the market. So don't treat your portfolio like an individual stock or security. Don't treat your mutual fund like an individual stock or security. They are not. They are a basket of securities. And by treating them as such, you're actually hurting yourself even more. Let the portfolio managers, let the fund managers do their job, and basically allow them to use their expertise and the resources that you and I just don't have. Now let's talk about investor overconfidence, and I see this too. People generally rate themselves as being above average in their abilities. They also overestimate the precision of their knowledge and their knowledge relative to others. Now, this is what I will say to that. In all the years that I've been in the industry, and it's been 30 years now, I've come across many do-it-yourself investors. And what I will say is that 90% of the time, portfolio managers have outperformed the do-it-yourself investors. But I have come across on occasion where a client, an investor, they have done really, really well. And there have been situations where I've said to them, you've done better than what our portfolio managers could offer you, because we are at a different risk profile as well. So there are occasions when, yes, I do come across someone who has done a really, really good job. And what tends to happen is they want to work with me and one or multiple portfolio managers that I refer to, because they've reached a point of they're now in retirement and they just don't want to take the level of risk they were taken on before. And they know that, they want to reduce their risk profile and preserve their capital. So I've seen a lot of that happen throughout the years. And many investors believe they can consistently time the market, but in reality, there's an overwhelming amount of evidence that proves otherwise. Is irrational behavior an anomaly? As we mentioned earlier, behavioral finance theories directly conflict with traditional finance academics. Each camp attempts to explain the behavior of investors and the implications of that behavior. So, who's right? The theory that most overly opposes behavioral finance is the efficient market hypothesis, associated with Eugene Fama, University of Chicago, and Ken French, MIT. Their theory that market prices efficiently incorporate all available information depends on the premise that investors are rational. EMH proponents argue that events like those dealt with the behavioral finance are just short-term anomalies or chance results, and that over the long term, these anomalies disappear with a return to market efficiency. Thus, there may not be enough evidence to suggest that market efficiency should be abandoned, since empirical evidence shows that markets tend to correct themselves over the long term. In his book Against the Gods, The Remarkable Story of Risk, Peter Bernstein makes a good point about what's at stake in the debate. While it is important to understand that the market doesn't work the way classical models think, there is a lot of evidence of hurting the behavioral finance concept of investors irrationally following the same course of action. But I don't know what you can do with that information to manage money. I remain unconvinced anyone is consistently making money out of it. So, what do we suggest? Well, sticking with solid strategies. Behavioral finance certainly reflects some of the attitudes embedded in the investment industry or system. Behaviorists will argue that investors often behave irrationally, producing inefficient markets and mispriced securities, not to mention opportunities to make money. That may be true for an instant, but consistently uncovering these inefficiencies is a challenge. Questions remain over whether these behavioral finance theories can be used to manage your money effectively and economically. That said, investors can be their own worst enemies. Trying to outguess the market doesn't pay off over the long term. In fact, it often results in quirky, irrational behavior, not to mention a dent in your wealth. Implementing a strategy that is well thought out and sticking to it may help you avoid many of these common investing mistakes. And that's really what it is follow a process, follow a philosophy. By reacting and overreacting, really the one thing that I've learned in business, in the investment industry, is the worst time to make a decision is when you're at your most stressed, when you're at the most fear, and even again when you're at your most confidence. We need to kind of be a little balanced when making our investment decisions. And if you're someone that's overly emotional and tends to ride up and down with the markets and listens to the media on a regular basis. I've said to many clients, stop listening to 680 News. If you're going to overreact every single time, then hire a portfolio manager. Let them manage your funds for you, because they're not going to overreact. They're looking at fundamentals. They're looking at, they're analyzing the situation. They're looking at the economy. They're looking at the actual values of those stocks. So just hire a portfolio manager. Now let's move on to the next, which is the deVere survey, which reveals millionaire investors' biggest mistakes. Yeah, millionaires do make mistakes. And here are the top three following this survey. So the number one at 38% is relying on historical returns. I think in this case, what they're suggesting is They've seen past performance of either certain asset classes, certain types of investments, thinking that that rate of return will continue moving forward. And we've always said that past performance is not indicative of future performance. You need to follow a process. You need to understand the people, the advisors that you're working with. What are their process? What are their strategies? And will they pivot? Will they change as things change? Think about it. In the early 80s, people were putting money into bonds and GICs paying 14, 15, 16%. We're now nowhere close to that. We have to change our strategies along the way. Now, the second at 35%, and this is a big one, was not having sought advice. So think about it. Millionaires, they're basically saying it's very close to the number one reason, but their second mistake was not seeking advice. And I always have maintained, I'm not an accountant. That's why I hire an accountant to do my books. I'm not a lawyer. That's why I hire a lawyer to deal with, my real estate transactions. If you're not an investment professional, you should probably work with an investment professional. Hire someone to assist you with your investments. In addition to that, if you're not a tax specialist, hire a tax specialist. Seek advice. It'll cost you less. You might think it costs a lot of money for the advice. Trust me, if you avoid a lot of the mistakes, it will save you a lot of money in the future. Now, the third mistake at 21% was the lack of diversification. So think about that. Millionaires are saying they didn't diversify enough. And this is why we work with certain firms, portfolio managers, who diversify their holdings in 10 different asset classes. We avoid mutual funds because within a mutual fund, you might only be able to hold 5 or 6. So diversify, include real estate in your portfolio, include whole life insurance policies that pay a dividend on an annualized basis. Diversification is very important to protect yourself, not only during times of corrections, but also on the upside too. Consistent returns is what we're looking for. So diversify. Now, I'm going to read here from deVere CEO and founder Nigel Green. He said, "It's interesting to see that for the first time in our surveys of this kind, that the number one investment mistake high net worth individuals have made is, they say, reliance on guidance from historical returns. DIY investing and not having a regularly reviewed plan is typically a path full of costly pitfalls." So if you don't have a plan, if all you're doing is investing your money without a strategy, without a plan in place, a plan that you can actually document, review, and perform progress reviews as well to see if you're on track based on your original goals. If you don't have that in place, that's like going on a trip without a GPS. That's like going on a trip without having a map. You need to map it all out. And hire someone who can do that for you. And if you don't know anyone, you can reach out to me. I will help you put that map in place or that plan in place. He added, "It's encouraging that seeking advice is deemed fundamental to success by millionaires, as it shows that DIY investing and not having a regularly reviewed plan is typically a path full of costly pitfalls." The survey was carried out by deVere Group, one of the world's largest independent financial advisory and fintech organizations, and queried 752 investors with investable assets of more than £1 million or the equivalent in the UK, Europe, Asia, Africa, the Middle East, Australasia, Latin America, and North America about their biggest errors whilst investing before they became clients. The lack of diversification was in some ways bound to make the top 3. Why? Because it is universally regarded as an investor's best tool to mitigate risks and capitalize on opportunities that arise, Nigel Green said. The fact that top 3 mistakes are all fairly close in percentage term says to the deVere boss that, in fact, they all link in pretty tight to number 2. That's to say, having a robust considered, and consistently reviewed strategy for your personal finances. Green concludes, to some, this could appear as if investing your hard earned money is dangerous. Yet nothing could be further from the truth. Not investing is likely to be more dangerous to your wealth over the longer term. This is shown by the fact that most of the world's wealthiest people are themselves committed investors. Now, that's it for today's podcast. I know I did a lot of reading, but I thought that these were very good articles to share. And as I mentioned, again, the links to these articles so you can see who wrote them, where they're from, are included in the podcast description. If you have any questions, you can reach out to me at financial@tvhgroup.ca, or you can visit my website, tvhfinancial.ca, or give us a call at 647-727-4668. This was Jim Leo, and this was another Tortoise and the Hare Financial Podcast. Take care.